India's stealth fintech pivot, why Tier-2 credit companies are suddenly out fundraising Bangalore unicorns. The consensus read is already outdated. What matters now is the second-order effect most commentary still ignores. We will map trigger, incentive shift, and downstream impact before the close. But this round reveals a structural shift that rewrites India's entire fintech thesis. The story isn't about the capital amount. It's about where the smart money is moving. Tier-2 and Tier-3 cities, places like Indore, Vadodara, Coimbatore, are becoming the highest ROI fintech battlegrounds in India. And the unit economics are brutally better than anything happening in Bangalore. Here's the arbitrage: a salaried professional in a Tier-2 city has a stable income, but traditional banks won't touch them. The branch economics don't work. Bangalore-based fintechs won't either. Customer acquisition costs are 4,000 rupees or more per person in metros. In Tier-2 cities, WeRize acquires customers for 800 to 1,200 rupees. That's a 70% cost advantage. And default rates? They're running 2.8 to 4.2% versus 7 to 9% for gig economy lenders in major cities. But here's the contrarian part: Tier-2 borrowers are more predictable than Tier-1 gig workers. A government school teacher in Ranchi has 30 years of employment stability ahead. A Bangalore Swiggy driver has an 8-month median tenure. Yet VCs spent the last 2 years pouring billions into the latter while overlooking the former. WeRize customers come back. 41% borrow again within 90 days. That's the repeat rate of a subscription business, not a commodity lending product. And the RBI's April 2026 guidelines explicitly prioritized credit deepening in underbanked regions. The regulator is giving these lenders a moat. Now, there's a parallel most people miss. Between 2015 and 2019, China ran through this exact playbook. Zhujian, Lixin Fintech, an ex-financial built $5 to $10 billion market cap serving second-tier city consumers locked out of traditional banking. They went from 0 to 50 million users in 4 years, mostly in cities most Westerners couldn't find on a map. India's infrastructure today is roughly where China's was in 2016. Smartphone penetration is at 65%. UPI processed 13.4 billion transactions in May alone. But credit penetration? Still at 11% of GDP versus 18% in comparable economies. That gap is the wedge. WeRize and its peers are becoming the first scalable credit option for 340 million Indians who got bank accounts via the Jan Dhan Yojana but never got credit cards. Watch First Club's simultaneous $55 million raise. That's not a coincidence, it's a signal of convergence. A warehouse club generates purchase data, 12,000 to 18,000 rupees average basket, 3.2 visits per member monthly. That data becomes the underwriting engine for point-of-sale credit. By Q4 2026, expect WeRize First Club-type partnerships. The embedded finance model is already 40% of GMV at China's Pinduoduo in Tier-3 cities. In India, it's sub 5% but growing at 180% year-over-year. 3 catalysts are accelerating this shift right now. First, the account aggregator framework. As of June 2026, 680 million bank accounts are accessible via AA consent architecture. A WeRize can now underwrite a Nashik teacher in 90 seconds using 18 months of salary data. No branch visit needed. Incumbent banks don't have the tech stack for this. Nimble fintechs do. Second, regional language AI just got real. Sarvam AI's Indic models and Google's Gemini 2.0 dropped customer service costs 60% for vernacular interactions. Language, previously a moat for regional players, is now a moat for regional customer bases against pan-India giants. Third, the cooling of metro fintech valuations. Paytm's turbulence, Cred's stalled path to profitability, slices down round, these have shattered the India equals payments plus BNPL narrative. Capital is rotating toward businesses with actual net interest margins and credit discipline. WeRize at a rumored 40. Million-dollar post-money implies profitable unit economics, not growth at all costs theater. Now, what does this mean? By March 2027, expect 12 to 18 Tier-2 Fintech rounds in the $5 to $15 million range. Cities like Lucknow, Vijayawada, and Bhubaneswar will produce their first Fintech unicorns by 2028. The all roads lead to Bangalore era is ending. Second, traditional banks will panic acquire. HDFC, ICICI, and Axis have negligible digital lending share in Tier-2 cities. By Q2 2027, expect acquisition offers at 8 to 12x revenue multiples. WeRize's playbook is clear: scale to profitability, then sell the distribution network to a bank desperate for presence. Third implication is export economics. India's handling of thin-file credit scoring with alternative data, UPI patterns, utility payments, phone PE merchant receipts, is 18 to 24 months ahead of Southeast Asia, Africa, and Latin America. By 2027, expect Indian fintechs to white-label their underwriting engines to Vietnamese and Nigerian lenders. But there are real risks. Over-leverage is one. If 8 to 10 fintechs chase the same Tier-2 segment simultaneously, default rates will spike. Udaipur already has 14 digital lenders versus 3 in 2024. Regulatory tightening is another. The RBI could cap interest rates if political pressure mounts around predatory lending. The Karnataka state election in June saw this emerge as a campaign issue. And macro shocks matter. Rural income slowdowns hit Tier-2 credit immediately. Here's the bottom line: India's fintech story is bifurcating. The Bangalore headline grabbers are fighting over 80 million affluent customers with deteriorating unit economics. Meanwhile, companies like WeRize are quietly building monopolistic positions in the 600 million person market that traditional finance never served. The $7 million rounds look modest now. But this is exactly how Lashin Fintech started before its $3.8 billion IPO. These investors aren't thinking about 2026 valuations. They're thinking about owning the credit rails for 500 million people by 2030. That's not a fintech bet. That's a generational infrastructure play. And it's happening outside every major VC hub in India. WeRize's $7 million raise barely registered on TechCrunch. But here's why it matters: while coastal VCs obsess over AI-wrapped payment apps, Tier-2 fintechs are quietly out-fundraising Bangalore unicorns with brutally better unit economics. Customer acquisition cost in Indore: 800 rupees. In Bangalore: 4,000, default rates. Tier-2 borrowers repeat borrow at 41% within 90 days, better than most subscription apps. This isn't fintech anymore. This is infrastructure. China's Lashin Fintech followed this exact playbook to a $3.8 billion IPO.